Welcome to This Explainer. Today, we're diving straight into Chapter 3 of Accountancy. But hey, we aren't just going to stare at a bunch of boring numbers. Instead, we're stepping right into the shoes of Raju, an entrepreneur who just officially opened the Raju Paniri Puri Center. We're going to track his entire business journey, literally from buying his very first sack of potatoes to recording it officially in his rulebook. So here is our roadmap for today's explainer. We'll be looking at the balance equation, checking out source documents and vouchers, unpacking the rules of debit and credit, exploring the journal, moving on to the ledger, and then wrapping up with a quick knowledge check to see what stuck.
All right, let's jump right into Section 1, the magic balance equation.
Okay, so think of this equation, assets equals liabilities plus capital, as a perfectly balanced physical weighing scale. Imagine Raju starts with 20,000 rupees of his own hard-earned savings. That right there is his capital. Then he borrows 10,000 rupees from his brother to help get things off the ground. That's a liability. Together, that 30,000 rupees buys his shiny high-end steel cart, which is his asset. So you've got 30,000 on the left side and 30,000 on the right side. It is perfectly level. Let's actually see this in action. Say Raju lands a massive catering order for his pani puri. The raw ingredients, like the flour and spices, cost him 45,000 rupees, meaning his inventory drops. But he gets paid 60,000 in cash, so cash shoots up by 60,000. Now, on the asset side alone, we're up by a net of 15,000. If we just left it there, our scale would totally tip over. But take a look at the right side. That 15,000 rupee difference, that is pure profit. And profit belongs to Raju, which increases his capital. And just like that, the scale balances perfectly once again.
Moving right along to Section 2, source documents and vouchers.
Now, before Raju writes a single number down in his books, he absolutely needs proof. We call these source documents. They're basically the pukka bills of the business world. Things like cash memos, invoices, and receipts. They're your admission tickets for entering data. But what happens if Raju buys a huge sack of chickpeas from the local market and completely loses that kacha bill receipt? How on earth does he record it? Well, that is exactly where our next document comes into play.
In that situation, Raju uses whatever evidence he has to create an internal form called a voucher. Take a look at this specimen of a transaction voucher on screen. It essentially dictates exactly which accounts need to get hit. And crucially, notice the spaces for prepared by and authorized by down at the bottom. This ensures strict internal control. It means Raju's brother knows that every single rupee of that 10,000 rupee loan is being tracked safely and securely.
That brings us to Section 3. The rules of debit and credit. I want you to meet a character we'll call Raju's gatekeeper. This gatekeeper only lets a transaction pass into the accounting books if the entry and exit gates, the debits and credits, match up perfectly. To know which is which, just remember the clear acronym: capital, liabilities, expenses, assets, and revenue. For assets and expenses, an increase is a debit, like when he buys more flour. For liabilities, capital, and revenue, it is the exact opposite. An increase is a credit. Just follow this grid and you'll get past the gatekeeper every time.
Next up, Section 4, the journal, also known as the daily diary.
So the journal is basically Raju's daybook. It's his chronological day-to-day diary. The actual physical act of writing in it is what we call journalizing. And every single entry gets what's known as a narration. Think of the narration as the short caption of a photograph. It just briefly explains the context, so if anyone is reading the diary months later, they know exactly what happened with that specific plate of pani puri.
Let's look at a really concrete example of this. Say Raju buys 30,000 rupees worth of essential spices on credit from Govind Traders. Under the particulars column, the purchases account is an expense, so it gets debited. Then, right on the next line, to Govind Traders account gets credited. Why? Because Raju's liability, his debt to them, just increased. One side goes up, the other matches it perfectly. Boom, the gatekeeper is happy.
Section 5 is all about the ledger final sorting. Now, the journal is chronological, and it's fantastic for daily records. But what if Raju wants to know his total outstanding debt to Govind Traders at a glance? For that, he needs the ledger. The ledger is analytical. It takes all that chronological data and sorts it into specific, individual folders. And the process of moving data from the journal over to the ledger? That's a process we call posting. Posting is a highly mechanical, step-by-step procedure. Step 1, you look at your journal entry and locate that specific account over in the ledger. Step 2, you enter the date on the exact side,
debit or credit, that the journal dictates. And step 3, in the details column, you write the name of the cross-account involved. This cross-referencing is brilliant because it means Raju can always trace any ledger entry right back to its original journal pairing. Let's visualize what this looks like. You'll see the classic format of a ledger account here, which is very often called a T account because of its shape. You can clearly see that T dividing the left and the right sides. The left is always the debit side, marked DR, and the right side is always the credit side, marked CR. So if this were Raju's purchases account, all those daily mint and potato purchases would be cleanly sorted onto the debit side right here.
And finally, Section 6. Let's test your accounting knowledge.
Let's test Raju's books with a super common street food scenario. Imagine Raju buys some plastic chairs and a table for his customers to sit at. So, furniture, and he pays for it immediately, in cash. I want you to mentally apply those clear rules we talked about. Which account gets the debit and which gets the credit? Take a second to think about it. All right, let's reveal the answer. The furniture account is debited and the cash account is credited. Let's break down the logic. Furniture is an asset. By buying it, our asset increases, and the rule says an increase in an asset is a debit. Cash is also an asset. By paying for that furniture, our cash decreases, and a decrease in an asset is a credit. One asset goes up, another goes down by the exact same amount. It is perfectly balanced.
Let's do one final provocative question because this one trips up a lot of beginners. Based on everything we've just covered, do the words debit and credit simply mean increase and decrease?
And the answer is a resounding no. It depends entirely on the nature of the account, whether it's an asset, liability, capital, expense, or revenue. A debit increases an asset, sure, but it actually decreases a liability. Once Raju, and once you, fully understand that, the gatekeeper is always going to let your transactions through. Thanks so much for joining me on this explainer. Keep learning and keep balancing those books.